All right. My name is Chris Campbell. I'm a practicing CPA, and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So, today I wanted to talk about this business acquisition, something that I came across recently. So, I've been working with a client or researching for a client who is looking to purchase a business. And usually, when you go through and purchase a business, you look at the company's financials. Right? The company that you're going to acquire, you take a look at the financials. It's a process that I went through when I purchased the business. And you take a look at the financials, and you want to have an idea that the numbers are what they say they are. Because most of the time, you base your purchase price mainly on what those financials are. So, who's to say that those financials are accurate? Now, that's usually what you have audited financial statements for. If you have audited financial statements, you have your accountant CPAs come in and they perform an audit on the books. And essentially, at the end of their procedure and take a look at the books, they sign off, create a letter and say, okay, these financials are legit. You give your opinion on it. And you get that stamp of approval from a CPA, and they can stand behind the numbers that are being presented. And it's great for public use. And you have some ease that the numbers are relatively accurate. Now, the issue or the problem with that is that a lot of companies don't have audited financials. There's really not much use of getting audited financials for companies that are generating less than, say, $5 to $10 million a year. If you're a publicly traded company, you have to have audited financials. If you're a private company, which isn't a case with what I've been researching with the client, they're a private company and they're not doing $5 to $10 million a year. So the company that they're looking at, they don't have audited financial statements. They have financials, but they're not audited. So from a purchaser standpoint, you say, okay, how do I know that these numbers are legit, that I can trust the numbers that I'm looking at here? If you find yourself in a situation where you want to acquire such a private company and the financials aren't audited, you want to get a different study called a quality of earnings report. It's not quite an audit. It's not as intensive an audit, but it also serves a different purpose of the audit. The purpose of the quality of earnings report is to do a deeper dive into the financials, get a little bit more of the story behind the financials. And you also want to normalize earnings. Now, when I say normalize, you want to make sure that what you're getting or what you're purchasing, that performance can sustain for when you actually purchase the company. So you want to try to take a deeper dive into the numbers to get a better idea of how you think the company will operate going forward. Now, the reason why you want to do that is because the financials may be accurate, but sometimes there's a story hidden within those numbers and things might not be what they seem. You want to take a deeper dive into the company and the numbers, and then for your own purposes as a buyer, make any adjustments based upon what you find, which could then adjust what you may be willing to pay for the company because you get a better sense of how that company will operate once you acquire. Because there are a number of things that can go into the financials but don't tell the whole story. So, for example, part of the procedure is you taking a look at the reporting procedures, because if you're going based upon your earnings that the company has made, you want to check out how are they reporting these earnings, because most financials, especially from an income statement, are presented on a accrual basis and that cash basis. Now that's important because you can book income on an accrual basis, but that doesn't necessarily mean you're collecting the cash. So one thing you have to take a look at is determining, is the company or the business cash flow? You could be booking a lot of revenue, a lot of sales, but let's say that you're doing collections as well. People pay you later and the company could have a problem collecting the money. So if they have bad or high accounts receivable, that can present a problem. The company doesn't cash it. But if you just take a look at your regular income statement, you'll see, oh, they had all these sales and everything looks great. So that's just one aspect of the things that you want to take a look at and dive into. Another thing that you may want to take a look at to normalize is, are the majority of the revenues created by just a few customers? Because if you're purchasing a company and you have a handful of customers, one, two, or three customers that are generating a bulk of the revenue, you can be in for a big shock or have a big risk if one of those companies decide to walk or leave once you take over. And then you may need to find out the story behind that. Is there a key person within the purchasing company why the revenues are so large? Maybe there's a key relationship between someone that's currently in the company and whatever that client may be, that they're so reliant. So doing a quality of earnings report, you could take that deeper dive and find those things out, because that could severely affect the price you're willing to pay. You have a large client that walks once you take over, then it severely decreases the value of the company once they walk. Another thing to kind of take a look at is key personnel. So are there key personnel that's just driving the revenue? And that key person may not be around once you take over. So these are all things that you would take a look at. Now that's on the revenue side, but now on the expense side, you want to make sure that the expenses are in check. You also want to check for redundancies. Maybe there are expenses that this company is incurring that you may not need to incur once you take over. Say, for example, facilities. Maybe you already have your own facility and you just plan on moving operations into your own facility and you don't plan to have the facility that the current business is in. You can make that as an adjustment. You also want to take a look at compensation. There might be redundancies in roles where you don't need certain personnel that they're currently paying for, or is there personnel that are being overpaid or underpaid? So maybe there's an excessive compensation for the owner or other key members that you may not take a look at. Another could be undercompensation. I've seen businesses where the company looks healthy, but then you realize the owner's not taking much of a salary, or they are, it's very little. And you find out that it's below market rate. So if they were paying market rate, the company may not be profitable. You also want to take into account anything that's extraordinary. So extraordinary items or things that may happen once in a lifetime. Prime example, I have a restaurant client whose business exploded during a pandemic. Revenue exploded during the pandemic because they were delivery and takeout, and they were one of the few restaurants that stayed open during the pandemic years, 2020, 2021. Business exploded. However, as the world started to open back up in 22, then revenue started to go down and kind of normalize because there were more options. Places were open, people were doing other things. Now, if my client in this instance were to present their financials at the end of 2020 or 2021, you would be like, oh my goodness, this company is fantastic. And if they were to try to sell, those financials would look a lot stronger than what they are today because things have normalized. So that's also a purpose of doing a quality of earnings, to try to figure that out. Because again, you want to try to normalize the earnings for the operations and get an idea of what it's going to look like after the purchase and not necessarily before. Also, you want to take a look at the fixed assets. The fixed assets might be large purchases, facilities. So are these things that you're going to be buying in the business and you're going to be using the equipment? What condition is it in? Is it old and raggedy and you're going to have to turn around and make a large investment in equipment shortly after? These are the things that you want to study. A company could have a lot of old equipment and it's all depreciated out, but it's also not accounting for now that you're going to have to make a large capital investment after you purchase the company because you find out the equipment is no good, or you feel like you need to upgrade it in order to operate the way that you need to operate. So these are the type of things that we want to take a look at or study when you look at the quality of earnings report, because that doesn't necessarily mean that the numbers are inaccurate. The numbers can be accurate. No one necessarily be lying or trying to cook the books or anything like that. It's just that there can be a number of stories that can get covered up in the numbers. So you want to get a quality of earnings report, and then you can make the adjustments as far as what the true earnings of that company would be for you. And then once you have that figure for yourself, you can then determine how much the purchase may be worth to you. You may do a study and find out that it might be worth from what it's being sold for, and it can go the other way as well. Now you can do both on the buy side and the sell side. So if you're a seller and you want to get ahead of things, you may want to be proactive. For your buyer, you may want to perform such a report for yourself to just point out some of the irregularities that might have happened during your time. But I see it more so for the sell side. It's part of the due diligence that you do when you want to make that purchase. But I've seen it where some sellers can be quite proactive, but the sellers usually don't want to do that because it's an expense that they don't want to pay. They feel like the buyer can go ahead and do it and take that expense. Plus, a buyer may feel like the report is biased, being that if a seller's paying for it versus you as the buyer, you may want to get that on your own so that the bias is towards your party, right? So if you're going to make the purchase and it's a big enough purchase where you feel like you're not sure if you're going to lose your shirt or not on the deal, go ahead and make the investment and get a quality of earnings report done. And that should be able to answer a lot of your questions about the company once you make that deep dive. So that's all for now. I hope it helped. So if you have any more questions about this topic or any other tax or accounting related questions, feel free to reach out. I'm happy to help. All right. So that's all for now, and I'll see you in the next one.